Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Oana.
As you can tell by Juana's hair, it is a super humid day here in Las Vegas. It is. Whoosh, it's done with my hair, too. I have like this thing I cannot comb out. It just sticks straight up. I think I'm just going to get it cut off because it's crazy. But that's what we're going to talk about today. Okay. We're going to talk about all cash offers. Mm-hmm. So this is an article. It's from Realtor.com. All cash offers from big investors recede, giving mom and pops an edge in the housing market. What's a mom and pop? What does that even mean?
It means you and me. It means individual investors owning 10 or less properties.
Okay, so what we're going to talk about is individual investors, the corporations that were buying and what happened to them, why they're not buying, what they're likely to do with all their houses, and then what current investors are doing with their purchases. Are they being cash? Or are they getting loans? We have all the numbers.
All the numbers.
We have all the numbers. Okay. All right. First quote from the article. The share of investors purchasing homes with cash fell to 64% in the first quarter of 2024, according to a recent Realtor.com report. That's quite a difference for the fourth quarter of 21, when it was 69.7% of investors with no mortgage contingency to help them win ultra-competitive bidding wars, and the lowest it's been since 2008. Wanda, this is what stands out the most in this stat. What they're saying is, when all those banks came in and flooded the market, it was about 70% of offers were all cash, and without them it's only 64%, and that's the lowest. So literally, I mean, if this was an election, that's like if you took the middle number, call it 67%, that's all within the margin of error. Mm-hmm. Like this is basically, it's like 2/3 of all investors regardless are doing cash, and the other third are doing financing.
Correct.
Right. So why is it then that people got upset? Because there are these videos that the stats came out that in some markets there were a high number of investors that were purchasing with institutional funds. Mm-hmm. Okay. And they were buying at one point anywhere from 18% to 35% of all homes that were for sale. Right. But they've basically gone away. But it was only that percentage of homes over a couple years. It wasn't that they own 35. Because I've had people say, but Todd, 35% of all rentals are owned by corporations. And that's not true, right? So why do you think people think that?
Because the way articles are written and the way media presents information is in a sensational way that purposely leads the audience to a conclusion that is incorrect in order to sensationalize something and get more eyeballs. Okay.
Here's the next quote. Small investors, defined as having purchased 10 or fewer homes since 2001, make up 62.6% of investor purchases from January to March 2024. That's only 3 whole months. That's the highest small investor share in the data's history since 2001, according to the Realtor.com report. We know some people who have more than 10 homes. Mm-hmm. And I mean, how do they even get these stats? Like it's only 3 months. Is there like a time of year when investors buy? When do you think investors buy?
When they find a good deal.
When do you think most good deals happen?
You know, I think that deals happen throughout the year. I think that investors tend to do better in the fall and in the winter. But that doesn't mean that they're not going to buy in the spring and the summer. I mean, if there's a good deal, then there's a good deal, and that's it. I mean, this is what they do. They are investors. They don't just take 6 months off and then come back and buy again. They are continually working on their business, and their business is to invest in real estate.
Yeah, we get a lot of people who, especially the last couple listings we've had have been sort of lower end listings, and we get like, as soon as the thing goes in the MLS, we get these super low ball, I'll give you $220 for the house when it's listed for $285, right? And it's great, you just want like 30% or whatever off the price right off the top.
Right. So this is investors who are just writing offer after offer on everything that goes in the MLS, hoping that something sticks.
Well, I mean, what's the strategy there? Because we've done 3,000 of these, and I remember in the day when they would fax the offers over, and it wouldn't even be an offer. It'd be like a sheet of paper with like for, this is the price, this is this, and whatever, and it'd
Right.
be like,
So it does work. About 2% of the offers that they submit actually end up being accepted, and then they close on maybe half of those. So out of 100 offers that they submit, they will close on 1% of them.
that sounds like Open Door and those guys. They just lowballed everybody,
exactly.
and they would get lucky and get somebody.
That's exactly right.
Not really a business like the sustainable. That's just income. They're just an opportunist.
Well, they are, but remember, they're using the services of a real estate agent that isn't costing them any money, because that real estate agent only gets paid if the purchase closes. So if you can get somebody to work for free for you, and then at some point you end up with an investment that you're satisfied with, then yeah, who wouldn't do that all day long with someone else's time and effort and energy?
Would you write 50 offers and do all that hassle just to have one accepted at some point in the future? I mean, it may take you months to write 50 offers.
So it takes 100 offers to get one accepted and closed. Yes.
All right. Here's the next quote. "It's better for everyone involved that institutional money is withdrawing from the single-family home space," he says. "It creates less artificial demand among buyers, therefore reducing some upward pressure on prices. It also leaves room for mom and pop investors to operate." Oana, I disagree with this. I don't think it's artificial demand. An investor buying an investment property because they sense there's a return to be made in both monthly rent, which increase, and a future appreciation of the property is not artificial. It's just traditionally it's always been individuals that bought rental homes. The big corporations weren't buying them historically. It was always people that bought them because that's how financing was set up for these things. But there was many years, if you look back, anybody who looks back at the last 15 years, they're kicking themselves for not buying every house they could get their hands on in 2011, because some houses are literally worth 3 or 4 times as much as they were worth.
That's true.
And you were collecting, I remember investors we took out were getting 10% per year return on their investment. They were getting 10% a year. Could you imagine a bond that paid 10% a year, and then at the end of the bond, 15 years later, paid you 4 times face value?
Pretty good.
That's a pretty good deal. Okay, so that was my thing on that. I don't think that it was artificial. I think they took an advantage of an opportunity and until home prices got back up to like where they felt they should be, and now it's just people like us, they're going to buy the houses, investment properties. Okay, here's another option. So the institutions were using other people's money. These are hedge funds, and they were paying cash. So here is an advantage for mom and pop investors. Okay, if an investment property in your market costs $200,000, not in California, you can buy one in all cash or put 20% down and buy 5 properties with the same amount of money. Schmidt says it makes sense to maximize your capital and acquire more cash flowing properties through financing. One, if you live in McAllen, Texas, probably $200,000, or parts of the Northeast maybe, you'll be able to get a house for nowhere on the West Coast. Not in Vegas for sure, you probably can't do that, but you definitely can in some cities, right? You can get, if you have $200,000, you can go out and get 5 investment properties, finance them, and just sit on them. Right? Do you think that it's going to be easier now without, BlackRock or whatever? Or do you think, like, the problem with BlackRock was if you were in a certain zip codes in Georgia, you were screwed because they just took over those zip codes and bought everything and pushed you out. But remember, there were zip codes they never touched. It's not like they bought all over the U.S. They had specific markets that they went in, and in other markets they just ignored them. So you think that's an opportunity for more mom and pop investors to go out and start acquiring real estate now?
So it is, because now all of a sudden they don't have to waive contingencies like inspections or due diligence or anything like that. So they actually have the opportunity to spend a little more time, do a little more thorough job of investigating the property and satisfying themselves that this is the right fit for their investment portfolio. They're not quite in such a hurry. There's not quite as much pressure.
This is a map of the top 5 markets where all cash investors are buying. Now, we'll just leave this up while we talk. Portland, Maine is a tourist destination. They're pricing people that live in Boston that have second homes or something up there. There's also the Navy is up there, the U.S. Navy. They build ships in the area. So that's an interesting area. Albuquerque is a growing area. New Mexico is a growing state, right? But prices are not ridiculous like California and Arizona prices. Toledo, Ohio, also not super high prices, right? But maybe a little bit of a growing state. McAllen, Texas is definitely growing, right? South Texas. My dad grew up in McAllen. My family was there, and I remember when it was 40,000 people. And I think it's 150,000 or something now. It's much bigger than it was. Ogden, Utah, that's the one that surprised me. Do you think that is, Utah's growing, it's a growing state. Do you think some of that's vacation buyers or
there's quite
second homes?
There's quite a bit of government in Ogden, Utah as well. So I think that's part of what's happening is, the ever-growing government footprint. So that's part of it. But Utah in general is a growing state, so that is a contributing factor.
Hill Air Force Base is up there. We flew in there a couple jets. Actually, 4 of us all went up there. We grabbed 4 jets and flew in there for the weekend. We went skiing at Alta. But Hill Air Force Base is a pretty nice base. I think they fly F-16s and something else up there. But it was kind of fun going in our orange and white naval training jets and doing all that. One of the interesting things is that there's the two biggest demographics for all cash, and if we take corporations and make them go away and just talk about like people, like just people, right? It's the low end, like cheaper markets, markets where the prices are lower, and then the opposite end, which are second home vacation homes. Why is that? Why are, like, the middle is mostly financing and the ends are mostly cash? Why is that for investor properties?
So are you talking about vacation homes or?
Yeah, vacation. And so think, like Laguna Beach or someplace high end,
right.
And then, yeah.
Okay. So obviously, as far as on the investment end, those are all cash because those are a section of the market that are more affordable, and maybe that there's less financing available as opposed to you're talking about vacation homes. In vacation homes, that's a price point where people maybe have less sensitivity, and they're looking for a vacation home. They're looking for a place to park cash, that sort of thing. So I think that's the consideration there.
Okay, so some of these people are just parking cash.
Right.
They have a bunch of cash. They don't know what to do with it. They go buy a $3 million vacation house somewhere that they spend like 3-4 months of the year, and the rest of the time it's probably empty.
Right.
That was one of the things. If you're ever in like LA and you go down to the South Bay, all those beaches like Hermosa Beach, Redondo Beach, Manhattan Beach,
right?
And you walk along that thing called the Strand. That's that little. It's all the houses that are jammed right up against the thing, and
right.
There's some big houses, but mostly they're skinny. And you go through there at night, and in not like in the summer, but maybe in the spring or the fall, and you see a lot of those places are completely dark.
Right.
And there's not people living in them year round. They're people that people live in SoCal or people that live in LA in the city or Brentwood or places like that. They got their beach house, and they go. Who knows? They spend the summer there, or they spend weekends there, or they do whatever. But
that's in a lot of beach communities, right? All the way in SoCal. So anything Newport Beach, Coronado, Venice Beach, all of that is like that.
So, but do you think most we could do a whole video on this? But most vacation second homes are either in lake areas, mountain areas, or beach areas. They're not like, I just leave Vegas and go to Barstow because I have a vacation house in Barstow that I go to for the winter when it's too hot in Barstow. Then I come to Vegas or whatever.
So vacation homes are places where people like to vacation. People generally like to vacation in either beach areas, ski areas, lake areas. So maybe for fishing or maybe hunting. Things that interest people, things that are recreational in nature.
Okay. Anyway, Oana, what is your ultimate take on these houses that the corporations bought, which is still only a couple % of all rental properties? Are these things eventually going to come back on the market? Are they just going to stay locked up, or what's the deal with that?
I think they're going to be paper that's traded. I don't think that they're going to come back on the open market. And what I mean by that is they're going to be bundled in some sort of grouping and then sold off, whether it's a specific market or maybe it's multiple markets in one bundle, whatever that looks like for both the investor that currently holds that portfolio and the next investor who's looking to purchase. Because sometimes investors are looking to grow multiple markets for their portfolio. So maybe if I have a portfolio that includes Florida, North Carolina, Nevada, and
maybe Georgia.
In Georgia, then maybe I would go to somebody and say, hey, I'm looking to grow these portfolios. What do you have in those areas? Let's put something together. So it's not just I'm looking to purchase in Nevada, for example.
Most of the places they were buying were in southern states. Mm-hmm. The other thing, too, is it's very cumbersome to sell these things one at a time.
It's expensive. Okay, so let's kind of put it, where it lies. So you're right. To your point, the Sun Belt has been a favorite place for investors forever and a day. And it is much more expensive to sell these one at a time. It is far more cost effective to sell them by bundling them, because when you sell them one at a time, it's just a much higher cost, right? Just like when you sell your property one at a time, it's a much higher cost. Now, what does it cost you? Well, it costs you somewhere between maybe 5 and 8% to sell a property. It's the same thing with an investor, even if they're getting a volume discount, it's still going to be pretty substantial, as opposed to just bundling the whole thing, getting a title company to give them a deal on title insurance on all these different properties, on escrow fees on all these different properties, and not having to pay realtor fees, closing costs, all this other jazz, and being able to do the transaction at one time versus in drips and drabs and deals that fall out and all that sort of drama that comes with selling properties one at a time.
Yeah, if you need $80 million for your fund, you're not going to sell the number of properties and wait 3 or 4 months to get all those things sold to pull your money out. You're going to go to some other institution, go, this is the portfolio, this is how much it's worth. We'll give you a 2% discount, write us a check. We'll just title all the properties in your name. Or they don't even do that. They leave them titled how they are. They just have a piece of paper that says that they have an interest in the properties, mm-hmm. and they go, okay, they're ours. They divert all the rents to them, and they de facto take over. Mm-hmm. This also saves them having to pay a lot of transfer taxes and things like that. Right. They just go, hey, you're the new owner, but we won't tell anybody. We'll just, when we sell them, they'll be yours or whatever. Right. So states are getting wise to that. Like, for example, Nevada is getting wise to that. And they do have to pay property transfer tax in Nevada, but not all states are quite to that point. And so that there may be some, to your point, some tax savings there. But even the tax savings aside, just the savings in the other fees are pretty substantial, especially when you're talking about a vast number of properties trading hands. Right. Okay. So bottom line is this: housing market, as we have correctly predicted, has returned to a more normal market. Mm-hmm. I still see people talking about, the foreclosure rate, Todd, it's 125% higher. Well, yeah, but it's the lowest, like literally it's ever been. And then, the number of homes on the market's up 12%. Yeah, but the number of homes on the market's the lowest it's ever been. We're still not back to historic numbers mm-hmm. for most of the major metrics. Foreclosures, number of houses, we're still well below. The housing market's still pretty stable. All this has happened with 7% interest rates. Mm-hmm. There's a high probability we're going to see low 5% interest rates by the end of 2025. They're saying maybe 8 rate cuts, 7 or 8 rate cuts by the end of 2025 for the federal funds rate. So, I mean, that's certainly not going to crash the housing. I can't wait to see the housing crash video where they say the drop in interest rates will crash the housing market after telling everybody interest rates going up would cause home prices to fall 40 or 50%. That's going to be a fun one to make fun of. Right. Well, those guys are totally making bank and getting tons of revenue from having so many viewers. So I think that they're laughing all the way to the bank as far as that goes. They're less interested in accuracy and more interested in the revenue that they generate from the videos. They're not interested in any accuracy. They make fake charts. It's pretty bad. Okay. So hope you had fun watching the video. Leave us your real estate related comments. We appreciate them. Please remember to subscribe, hit the notification bell, like the video, share the video. And if you're interested in buying or selling real estate anywhere in the country, but in particular here in Las Vegas, give us a shout out and we'll be happy to help. We'll see you on the next video. Bye. Bye.